All right. Good morning, everybody. We get FOMC minutes today, and we have the VIX expiration uh, bright and early this morning. Spot Gamma actually had their AM edition founders note out already, which talked about that in a little bit of detail. And then they gave some forward guidance. It appears they're looking for a bullish move after the NVDA report, which was my first inclination to start the week too. Just keep in mind, if everybody's looking in one direction, or if everybody starts to believe they've got the answer to what the market is going to do, then it opens the possibility to be offsides if they're wrong. The markets don't like surprises. So if you read the Spot Gamma Founders Note, they talk about using the SMH for a proxy play to run a bullish opportunity. It's worth reading, taking a look at. Just they've been talking about it since last Friday, and I post, the founders note every day. So if you want to start with their first discussion of the SMH trade, go back to the Friday Spot Gamma founders notes and then begin reading it from there down. And I've had people say, they don't really trade options that much. They don't. The material seems a bit overhead. I'm not asking you to understand the entire document, but if they're talking about an equity trade bullish SMH long, I mean, a trader is a trader. You should be able to figure that out. Don't have to get into the complex things of GEX levels and, fall down the rabbit hole into optionality. The entire world is flat waiting on this. We don't really have any movement. Keep in mind, next week is a short week with the holiday at Memorial Day. The data out of Japan didn't move markets either. We're going to get the 1 o'clock bond auction. This is something I mentioned earlier this week. This one's a good one to keep your eye on. I'm a big fan of these auctions. I pay attention to them all the time, even though it feels like maybe sometimes I'm the only one that does it. They never list them as impactful. It's always shown in this really light outline, but these things can move markets. So that 1 o'clock auction is certainly worth paying attention to. And I've noticed there's other auctions that don't always get listed here either. So if I see an auction at 11, 11:30, or 1, and I don't see an auction on either of those other two time frames, then I just assume they all three have auctions today. So I would anticipate an 11 o'clock auction, an 11:30 auction, and then the 1 o'clock one as well. It doesn't hurt to be prepared. And then if we don't get any activity out of it, then so what? At least you were prepared for it. The data coming out of the UK, they did a really good job telegraphing their intent and not really expecting too much behavior out of that. It should be a pretty boring sideways day, just like yesterday, just like Monday, holding the line, holding these levels. It is worth noting, if we look at just a typical floor pivot, that the pivot opened higher than the previous pivot, that we didn't hit the R1. We've already touched the pivot, crossed under it. And if we were to put the channel on, the channel is overlapping the previous pivot. If you heard me talk about these central pivot ranges, floor pivots, and their context on the day, then you kind of got an idea what we're looking at, why we look at it. The wider this shadowed area, the highlighted yellow area, the wider that area, the more likely it is that we'll have a range day. And the skinnier that range, the more likely it is we could have a trend day. This just sets a bias or a tone, right? It's not guaranteed that it'll be a range day or a trend day, but we try to get a feel for, what's the day going to give us? And we try to do this because when we come up to a previous pivot point, we want to kind of have an idea, should we short that sucker or should we buy the breakout? Price can fool us and it can look very bullish. Down at the lows, if we're coming into yesterday's low, price can look very bearish. Should we buy that low, sell into weakness, or should we buy into that weakness? And when we have a bias already, before price ever gets to that low, if we already believe that today is not supposed to be a trend day, that we shouldn't break down here, that we shouldn't continue to go lower, then we're anticipating this reversal. Doesn't mean we have to put the order on before it even reverses, or that we have to trade this flip. But if you're struggling with trying to identify breakouts and breakdowns and whether or not you should go long or short, whether or not it's going to reverse, then having a bias in place first before price tries to trick you will help. This is just one of the ways we try to anticipate what kind of trading day are we going to have. Spot Gamma has something called the Gamma Index. It ranges from a -4 to a +4. If the Gamma Index is above 0 and closer to the +4 side, it's more likely that we'll range. And when the number is closer to the -4, it's more likely that breakouts and breakdowns will continue to expand farther. So it's another way of trying to gauge what's today supposed to be. But it's not just that, it's checking the news. If you've seen any headlines since Friday, it's all been about NVIDIA, and everything you read says the market's waiting on NVIDIA. I mean, how many more signs do you need shoved in your face that says we're not going to break out, we're not going to break down, we're going to hold this range until NVIDIA, that you know that it's going to be a range and we're waiting on NVIDIA? This one has been pretty obvious. There's other obvious ones like an FOMC week, CPI week. There's events that show up on the horizon that tell us we're very likely going to sit sideways and wait on data. And this is the kind of price action that you'll want to anticipate on those kind of weeks. So, it's not always indicators and fancy tools. Sometimes it's just taking a look around at the headlines and seeing what the collective outlook is. And they can be wrong. By all means, don't think that if you read a couple of headlines that say we're probably going to go sideways, that we have to go sideways, because we don't. Price doesn't have to do anything. $53.50 is an options level, even if it's not listed per se here. It's a round number. It's a solid number, a quarter number. If it was 53.25, 53.50, 53.75, 5400, I don't care if you see an options level there. It's an options level. Treat it as such. Just anticipate if it's over your head, it'll have some profit taking there. It'll be a wall of sellers and it'll be hard to get through. And if it's underneath this, then it's a floor of buyers and it'll be a little hard to get through. Doesn't mean we can't break through it. Just we want to anticipate those levels as areas of elevated trading activity. We'll expect those areas to be defended. We're flat. We haven't done anything. We're kind of mid-range between the ADRs, which we haven't hit. We haven't really interacted with the ADRs this week. I think we tagged it, depending on which one you trade, the ES, NASDAQ. We've been there, but they haven't been the focus because the expectation is that we're just not going to do anything because we're waiting on NVIDIA. Take everything off and take a look at yesterday. Highlights our levels for the day. You can see we've already got a half back test. We lay out Monday's levels. It was very close to a half back test. The same situation as yesterday, just on the other side, right? That's all we've done. We're just overlapping, building up more and more levels. And I mention this because if you're not familiar with the way hedging and options work, and I get it, a lot of futures traders, that's all they've done. They haven't gotten into options. They don't want to trade options. But all these markets are connected, especially when it comes to hedging. Futures are used to hedge options trades. And futures have options too. So if they are trading futures, you'll see them hedging with options. If they're trading options, say in SPY, SPX, they'll hedge with ES futures. You don't have to try to wrap your head around that. You just have to realize that the money's connected and that you want to follow the money, right? It's kind of the old adage. So the longer we stay in a range sideways like this, the longer or the more that levels get built up. And just generically speaking, if you were going to short from here, you would very likely have your stops up here. It's generic, right? Same thing. If you were going to go long from here, you would have your stops along the lows. That's kind of an equity concept, but it's trading 101. Put your stop outside the range so you're not playing in traffic. The longer we stay in one spot, the more that builds and builds and builds and builds until there's just this overwhelming amount of liquidity on each side of this zone. We call this a draw. It just like it sounds, it draws in everybody. Longs don't know if they're wrong yet. Shorts don't know if they're wrong yet. Everybody gets a chance to throw their hat in the ring and build more and more and more levels. More and more money is piling up on either side. So first we draw in the money. Then it's very likely that we will raid one side or the other, raid that liquidity, and then move in the opposite direction. I've seen the raid and draw constantly. It's just what we do. But here's a good example of a narrow, smaller version of a raid and draw. So sideways range, draw in the liquidity, gather all of that liquidity up in a raid, and then take that liquidity for a run higher. Could have gone the other way around, but either way. This sideways range building up a lot of liquidity is why you'll oftentimes see where we break both sides and start building out a megaphone pattern. Get into the liquidity on each side, winding wider and wider until something finally breaks, and then we take off. So I mentioned this because today, if or when price decides that it's done sitting in this range, that it's had enough, it's ready to go, it doesn't want to wait for the NVDA earnings or the FOMC at 2 o'clock or whatever it is that may break us out of the zone today, up or down, just keep in mind we're still anticipating a sideways market into the end of the day. I've already mentioned we don't have to go sideways, but no matter how bullish it is, you're going to want to see confirming signals that it really is breaking out of 53.50 and continuing to go higher, or that we really are breaking down below 53.11 and are going to go lower. 10-day, 30-minute chart, TPO and volume profile. The TPO is in blue. The volume profile is in green. If we do break that 53.11 cog line, then we got this air pocket here where we could just drop really fast down to 52.50. Throughout the week, this week, we're going to continue to see this range narrow. And by next week, unless we break this high and continue to go higher, this will be the narrow range that we have. It's a 10-day range. It's pretty narrow for a 10-day range. We've seen tighter, but usually that's closer to, short weeks and holidays and that kind of behavior. We're going to be getting deeper into summer. Should see lower volumes. Kind of common to see a more narrow 10-day profile at that point. But if we follow what Spot Gamma is saying and we break out, then this will leave behind the point of control and we will no longer have this air pocket to deal with. It'll pretty much be out of our way at that point. What we need to be mindful of at that point will be a classic B shape. Profile with a classic B. We'll still have the point of control down here for the moment, and we'll have to watch this to see if it's going to be, a week high or not. Got a new VPOC level from yesterday. So if we continue to fade to the downside this morning, 53.33 as a VPOC line. That's really close to the COG line, 53.32, 53.31. You don't have to stress on whichever one. It's just so close. That whole thing is COG, COG, center of gravity. This gray line here, 53.27, is where we closed Friday. So all week we've done nothing. This is the same range we were talking about Monday and Tuesday. Thursday's high to Friday's low and sitting in this box. It's not perfectly equidistant to the red and green lines here, but that's going to be the idea. You can lay those levels out if you want to. Offer a little bit extra for targets. Those will be areas of interest. with that little bit of a drive that we had yesterday, we got a little higher, a little farther away from the 10-day, but on the 10-week, we're still 2.43, 2.44, still a bit of a decline. It's looking good here, not overbought, not overextended. Probably helps that we've already started to unwind a little bit of that move. Still nowhere near that 1.5% on distance from the 10-day. So everything is just looking fine. We're ready to go. If you think about the center of a basketball court, you're equally distant to either goal, right? So you have room to run up or down the court. But if you're already on one side of the court, you really got nowhere to go but the other direction. We don't have that edge right now. Right? We're not sitting at the lows of a zone or a range or support or anything like that. We're not sitting at the highs against resistance or anything like that. We're right in the middle of the court. 50-50 coin toss. That's not the way you want to approach a trade. Now, NVIDIA is the bellwether for all of this AI enthusiasm. And it's worth considering the idea that it very likely is going to move everything. So if it isn't good, the market's going to sell off. It's not like we're going to go, to bear levels or anything like that. But if you're holding longs, in any kind of junior tech or any tech that's using any sort of AI, all the Mag 7s, if you're holding any of those things, opposite of whatever NVIDIA does, you're going to get whacked. And I mentioned this, somebody was asking about a couple of different names yesterday, Intel, 3M, I just go down the list. And they're not necessarily bad trades that they're holding, but the trades are, a little under pressure. Plenty of time left on every one of the trades that in question. But if the trade is already struggling a little bit, it's not doing that well. Sure, it has months left before the trade expires, and you're sitting right in front of an event like this that could just wipe out your trade. Might want to consider this. Hedging your position, locking in whatever it is, a minor profit, a minor loss, just getting the heck out of the way. There's a concept in trading about forced errors. And I've seen this. I think we all kind of probably did it ourselves when we were newer. Someone who might be focused on SPY and takes a long call for 20 days out. And then they're looking at the Qs and they take a long put 35 days out or 40 days out. Sure, they got different time frames, but one of those is probably going to lose, right? Or being long Apple and short SPY, long Microsoft and short the Qs. Forced error. You're just locking yourself into a position where one of those are very likely going to lose. Or both. And we try to watch things that are correlated to what we trade. Well, right now, NVIDIA is big enough that it might hit things that you don't even think are correlated with it. So really take a look at what you're holding. Because as much as everybody believes this is going to be an up move. Even yesterday, I said I'm pretty confident that NVIDIA's got this under control, that they'll have a great earnings and a good forward guidance. The market is not a rational place. Bitcoin is up this morning with cloud computing. No, not with cloud computing. What's up with this? Bitcoin semiconductors through the SMH. And that's it. Those two. That's all we've got. And for the downside, gold miners. Bonds not quite there. It's close. It's at 0.4. Once it gets to 0.5, then we'll be able to say bonds down too. This is a Mag 7 homemade version, right? You can change the weightings. It's really only good because it functions pre-market. You can do it with no weightings at all. You could just wait for the open and use the NY Fang. I've had people ask about these weightings, and I've seen different ones. It looks really smart and sophisticated to have all these numbers and the formulas in there, and just, I mean, I'll share it if you want it. The point is, you don't need it. You don't need the weighted numbers. I only have it because they're already there. I'm not going to go in and delete it just to get rid of it. But if you just take Apple plus Microsoft plus Google, Amazon, NVIDIA, Meta, you can make this with no weights at all, and it will look damn near identical to what we're looking at here. This is useful for pre-market. You can do it on TradingView, Thinkorswim. There's a lot of brokers that'll let you add markets together like that, make your own little homemade ETF or index. We're sitting in blue sky territory with the Mag 7. You know, this is as divergent as they all are collectively, they're still doing really good. And it has Tesla in there with all that weakness. You know, and Amazon took a big move yesterday. It's still doing really good. All right. Dollar's continuing to stretch to the upside this morning. So is the 2-year in front of the VIX expiration. These two markets, the one on the right and left here, very often move opposite of the ES when we get events like CPI, FOMC, VIX expirations, things like that. So if they are continuing to drive to the upside, especially right in front of news, the ES very likely is going to break to the downside. This setup right here, I put together from Finance Juice. Very often when Finance Juice reports things, it will use that 3-grid chart setup, usually with a big bright banner headline, and you know it's what they do. And I found it to be oddly present. You'll see the move in the dollar and the 2-year very often before the event itself, as opposed to, you know, getting the event and then getting the move. I still don't trust it enough to say, you know, that if it's going down, that I would expect the ES to go up, or that if it's going up, I expect the ES to go down enough to actually trade it in advance. I'm not there yet, but I do pay attention to when it starts to move a little early, and it is starting to move a little early. It is signaling a downward move. So we're at the half back of yesterday. Should we break that? We've got the Globex high No, we're through with that too. The Globex low of yesterday, the RTH open of yesterday, and the RTH low of yesterday. So we still have a couple of pivots down there. Now the low and the open aren't as far apart as I would like. That 5-minute range wouldn't be bad though. Take the 5-minute high, the 5-minute low. 5-minute low is the low of the day. That would give us another bottom like we've talked about before when it comes to double bottoms, double tops. Remember, they're bear traps. Price is supposed to go lower than the previous low. If it bounces right on the line, then it's more of akin to a cup and handle or an inverse cup and handle. It's supposed to go through the previous low, tangle into like a 111 area, what I call the warning center. If it's a double bottom, it's a bear trap. It needs to actually convince bears that we're trying to break out and go lower so that it traps them, right? So that they'll get in and get trapped. So when we get this FOM or this VIX expiry volatility this morning, if we can break this pivot and get to the low of yesterday, which is the low of the week, really, we'll be looking for that reversal, that flip to see if it's a bear trap. I'm only looking to the downside here because of the 2 and the dollar. Otherwise, you know, we could just as easily be looking to the upside with yesterday's high or the high of the week that we set here in the Globex this morning. And it'd be the same thing, just a double top instead of a double bottom. Seeing more out of agriculture. I mean, it's trying. You know, it's worth keeping an eye on. It took a beat down from cocoa. If it can get decoupled from that some way, turn things around, it's worth keeping an eye on. We got FXI, SMH. I mean, there's really not a lot here. We're just waiting on this data. So another really short morning briefing. Be careful, be safe, keep your eye on the clock. Got a lot more things on the table today than you'd